Imagine waking up tomorrow and realizing something unsettling. The money in your bank account, the cash in your wallet, the digits on every financial screen you've ever trusted, may not be determined solely by governments or policies. Your mortgage, your savings, your pension, even the value of your paycheck. All of it can be shaped by forces far beyond legislation, elections, or public oversight. According to several economic historians, behind every nation, every currency, and every crisis exists a complex financial architecture, a system built over centuries, that guides the flow of money globally. Today, we explore that architecture, and we confront a provocative question. If you don't fully control your money, who influences it? The answer might surprise you. Money alone does not run the world. Power and influence do. And the most potent form of financial influence is the ability to create and direct money on a large scale. History offers examples. Rome's silver economy, Britain's gold-backed pound, America's Federal Reserve System, today's network of central banks, major investment firms, and supranational organizations. Together, these elements form a complex global system that guides the movement of wealth across nations. Historians note that this system evolved gradually, shaped over centuries by wars, trade, and financial innovation. Many people assume that governments directly control the currency and financial system. However, some economic analysts argue that the reality is more nuanced. Monetary policy, banking regulations, and global capital flows often operate under influences that extend beyond elected officials. In other words, governments operate within a system shaped by history, institutions, and market forces, sometimes limiting their own options. Today, we explore how these dynamics have evolved. To understand today's system, we return to 1694. Britain faced crippling war debt. Private financiers offered a solution. We can provide loans if a national bank is established. The Bank of England was created, providing the government with structured borrowing while giving financiers significant influence over the monetary system. Historians note that this marked the beginning of a pattern. Centralized financial institutions gained a new kind of leverage, influencing governments and markets in ways that persist today. The 20th century saw the expansion of central bank influence. Crises, from wars to depressions, shaped their authority. The Panic of 1907 led to the Federal Reserve's creation. Structured as a hybrid public-private institution, designed to stabilize markets, capable of influencing credit and liquidity. Analysts note that through monetary policy, central banks affect economic behavior, encouraging growth during expansion or caution during contraction. Interest rate shifts influence borrowing, spending, and investment, subtle levers that guide economies without direct legislation. Central banks operate within a larger global financial ecosystem. Major investment firms, rating agencies, and supranational institutions also play influential roles. BlackRock, Vanguard, State Street, IMF, World Bank, BIS. Some scholars argue that decisions in this layer can significantly impact markets and even influence national policy indirectly. For example, allocation of capital or lending priorities can create ripple effects in economies, but this influence is debated and subject to historical context. Debt is a nation's largest recurring expense. Government bonds are key tools for financing, and shifts in bond markets can affect national economies. In some cases, market pressures have contributed to political transitions. Italy, 2011, faced shifts influenced by bond market conditions. UK, 2022, saw rapid policy reversals due to market reactions. Economic historians note that markets can indirectly shape political decision-making, but these effects are part of a complex system, not direct manipulation. The global financial system can be viewed as an interconnected hierarchy. Central banks influence money supply and interest rates. Investment firms allocate large volumes of capital across markets. Bond markets respond to government borrowing and fiscal policy. Supranational institutions, IMF, World Bank, BIS provide frameworks and guidance. Governments operate within the frameworks created by the above layers. At the foundation of this system lies something more fundamental: trust, confidence, and belief in the value of money, elements that shape every financial interaction. Money functions because billions believe in it. Trust, stability, and confidence underpin the entire system. Bank confidence prevents runs. Currency trust prevents hyperinflation. Market stability depends on collective belief. Economic historians emphasize that shaping public perception and trust is as vital as policy itself. Narrative and confidence are integral to monetary stability. August 15, 1971, the U.S. ends the gold standard. Money becomes untethered from gold, belief-based, more flexible than ever. Debt levels rise. Markets expand. Generations increasingly rely on credit. Historians call this the beginning of the age of debt, highlighting how monetary policy and financial structures influence wealth distribution over time. Over the last 40 years, wealth concentration has increased. Wages for many have stagnated. Crises have become cyclical. Assets often exceed underlying economic value. Economists suggest this reflects the natural outcomes of centralized financial systems and global capital flows. Those closest to the creation and allocation of money often gain the most. A new financial architecture is emerging. Central bank digital currencies, CBDCs. AI-driven credit systems. Programmable money. Cross-border digital settlements. Some policy papers and expert debates explore possible features, such as transaction programmability or digital tracking, but these remain speculative and vary by country. The key point: the financial system continues to evolve, with ongoing discussions about capabilities and safeguards. Control of money is complex. Monetary design, institutional incentives, global capital flows, public perception and trust. Different schools of thought propose varying levels of influence among these elements. Those who study and understand the system can navigate it more effectively, while those who don't are more influenced by its structure. If money is a system sustained by belief and institutional frameworks, the real question isn't who controls the system. It is, how will trust, perception, and policy shape the next chapter of global finance? And when change comes, who will guide the evolution of money next? If this revealed something deeper, subscribe. The patterns of history never lie, and I'll guide you through them.